My name is Phil Diekman. I'm the Senior Vice President with Hunterdon Health Foundation. And I want to welcome you all to our webinar today on donor advised funds and the anticipated changes that are coming in the tax code that specifically impact charitable giving. So the end of the calendar year is a time when we have significant charitable giving. Hunterdon Health Foundation is no exception. And in light of these changes, we thought it would be great to share some insight. Before we jump in, I want to share a couple of items of business items. By default, everyone on this call is on mute, except our presenters. If you have a question, I would encourage you to put that in the text box, which can be accessed on the bottom right-hand corner of your screen. It's a little call-out box with the lines going across it. In addition, we will, some of you have cameras on. By all means, nobody's required to do so. To turn them off, you can do that with the second button from the left on there. Finally, this presentation is being recorded, and we'll be glad to share that recording with you after today's presentation. And in addition, it'll be available to everyone on our website. So again, thank you for attending today's presentation. I want to especially thank our guest presenters, Dave Johnston, Dave Estanislao, and Joe Gislao. Specifically, I want to say a big thank you to Dave Johnston. Dave is a Hunterdon Health Foundation board member, and he's the one who generously agreed to put together today's presentation when I called him looking for help. So hopefully not the last time Dave answers my phone calls, but Dave is a highly respected member of the Hunterdon and Flemington community. In addition to being a board member and a member of our community, he's a partner and wealth management advisor at OnePoint BFG Wealth Partners and a certified financial planner. Dave is widely recognized for his clear, practical approach to financial planning, and his insights are regularly featured in national media outlets. So he and his team and his colleagues are perfect for this information today. So again, thank you all for being here. And with that said, I'll pass you over to Dave.
Thanks, Phil. I'm happy to be part of this. I have a big passion for charitable giving, and obviously it goes to the next level for organizations that I'm involved in. So I think the timing of this was great, as the participants will find out, and hopefully we can bring charitable giving to top of mind, and even with some of the potential, with the forthcoming tax rules and tax law changes, some of those take action sooner than later may make sense. So thanks. Happy to be aboard. We have David Estanislao from Schwab Charitable. He actually is senior manager in that department. He's going to be giving the thrust of this presentation, and also with a partner of mine, Joe Gislao. He's a director of financial planning at OnePoint, my firm as well. So I think the three-headed monster that we have put here together will really be beneficial for you. So Dave, I'll ask you to kind of kick off and take us away.
Dave and Phil, thank you so much for the kind introduction. It's a pleasure to be here in front of all of you today. As Dave mentioned, I'm a senior manager on the charitable consulting team at DAF Giving 360, formerly known as Schwab Charitable. I've spent over a decade working with advisors and high net worth individuals around charitable planning and philanthropy. I've also received the Chartered Advisor in Philanthropy designation. So, in my role specifically, I provide charitable education and resources to both advisors and high net worth individuals. So I'm really happy to be a resource for all of you today. When we look at the next slide, what are we covering? So today is all about education. We'll cover key updates in the charitable environment, what to expect moving ahead, and practical tax smart strategies you can use. We'll also, take a look at the donor advised fund, which is, arguably the most popular and widely used charitable vehicle available, and the value they provide to both donors and nonprofits. Basically what they are, how they work. We'll cover it all. I'll also share several free resources to support you as you plan your philanthropy. So let's dive right into charitable trends here. I love leading off with this graphic because there's no surprise that the United States is extremely charitable. In fact, it's a $500 billion industry that continues to rise. Total charitable giving reached over $592 billion in 2024, increasing over $35 billion in current dollars from 2023. The average year to change in total giving between 1984 and 2024 was an increase of $13 billion. So again, I always like to lead off and really show a visual image of that upward trajectory that charitable giving remains strong here in the U.S. And what does that look like? When we look at the next slide here, individuals represent a majority of all of the giving in the U.S. Actually, 66% are done at the individual level. 19% of all gifts made in 2024 were made by foundations, and that's inclusive of independent, community, and operating foundations. Then following that are bequests at 8%. And then finally, corporations comprised of 7% of all the total giving in 2024. So we just wanted to provide a little bit of the charitable landscape before we dive in here. Now, just a 2-minute commercial about DAF Giving 360, Schwab Charitable. We are an independent public charity with a mission to increase charitable giving in the U.S. And we do this by providing the Donor Advised Fund, which is a tax-smart, simple giving solution that we provide, and we'll talk a little bit about it. But also, want to show really since our inception on the next slide here, been at this for over 25 years. We've given over $44 billion to over 280,000 charities in the U.S., really cementing ourselves as a true leader in this space, and all that great involvement from our donors out to charities. In fact, on the next slide here, just last year, we've given almost $9 billion to over 155,000 charities in the U.S. So that is a big part of why I joined this great organization and the great work that we do. Now, when we're talking about the Donor Advised Fund, just simply put, a Donor Advised Fund, or a DAF, as it's sometimes referred to, is simply an investment account for your giving. Donors make an irrevocable gift of cash or non-cash assets to the fund, and we'll get into that a bit deeper into the presentation. But then you have the ability to invest those assets for tax-free growth. So in theory, you have more money to give to charity. You will receive a tax deduction in the year that you fund the account. So that's really, really important to note, that you're getting the deduction the year that you fund and not when you're making the grants out. So you have that flexibility to grant assets out over time, to be more strategic with your philanthropy. It's a very tax-smart vehicle which maximizes the donor's impact of their giving by making charitable gifts go further. And I really like to stress the convenience and the ease of giving, right? Giving should be easy, and the Donor Advised Fund is really that conduit to do so. More affordable than other more complex giving vehicles. For example, let's say a private foundation where you may need an attorney to set up the entity and ongoing costs for administration, etc. So, the Donor Advised Fund is really widely popular because of the flexibility and control here with your giving. Next slide here. Donor Advised Funds benefit both donors and charities, and this is a very, very important note on how we all pull on the same rope, right? Many times traditional 501c3 organizations do not have the ability to take on kind of these non-cash assets. They don't have the expertise or the ability to liquidate, etc. Donor Advised Funds do. So in theory, you're able to take on more of these charitable assets that are more than just cash, where the donor advised fund again will take on this asset, convert it, liquidate, whatever terminology you'd like to utilize, where the cash can now go in the hands of the charity. So at the end of the day, donor advised funds benefit both donors and charities, and we pull on the same rope there. Now, really the crux of today, the current giving environment, a new federal tax law was approved in July, right? I'm sure you all heard about it. Whether you take the standard deduction or itemized deductions when filing your taxes, or even if you're uncertain on what you'll do, the new law has 8 provisions that may influence your charitable and tax planning in 2025 and beyond. In this slide, we separated the 8 provisions really in 2 categories. So let's start with the new tax provisions. The tax benefit of itemized charitable deductions will be capped at 35% for the top individual tax bracket starting in 2026. That's down from 37%. So donors in that top tax bracket who itemize deductions and are planning a large gift in the future may want to accelerate their gift to 2025. Provision 2, itemized charitable deductions must exceed 0.5% of adjusted gross income, AGI, starting in 2026. So donors who itemize their deductions may need to increase their giving amounts each year and explore what we call a bunching strategy. So bunching contributions if they intend to itemize deductions when filing taxes. And I'll talk about that a little bit more in the next slide. Provision 3, the non-itemizer charitable deduction is increased to $1,000 for single filers and $2,000 for married couples filing jointly. That deduction, it's important to note, the deduction excludes donor advised fund contributions. So donors who take that standard deduction can now receive some tax benefits for their giving. Now, as I mentioned, the law also includes 5 provisions that are really extensions of the 2017 Tax Cuts and Jobs Act. First provision there, the current income tax brackets are permanent, right? So they're permanent. So that really helps both itemizers and non-itemizers plan future giving relative to their taxes, given that it is now permanent. Secondly, higher standard deduction amounts continue. The amounts are further raised by $1,000 for single filers and then an additional $2,000 for married couples filing jointly to $15,750 and $31,500 for tax year 2025. Standard deduction amounts are also adjusted in the future for inflation. So that's an important note. Now, this provision really helps donors whether they have itemized deductions exceeding the standard deduction and determine years where bunching contributions may be beneficial. Third provision here, the 60% of adjusted gross income limit on itemized charitable deductions for cash contributions is permanent, applicable for 501c3 public charities. So donors who itemized deductions continue to receive the benefit, and the deduction limits continue to be higher than 30% limit for cash contributions to a private foundation, right? So, that's the benefit there. Fourth, I guess the fourth provision here under the extensions of 2017 tax cuts, the increased estate and gift tax exemption level, it continues to increase. It's raised to $15 million for single filers and $30 million for married couples filing jointly in 2026. The exemption level also has further adjustments for inflation, which provision really creates a higher level at which assets start being assessed a tax, resulting in a majority of estates not being subject to federal estate taxes and creating a new charitable legacy planning opportunities. And then finally, the fifth component here, the increased state and local tax deduction, SALT, right, of $10,000 for itemized further increases to $40,000 for 2025. It increases annually by 1% through 2029, phases out for income over $500,000. So the opportunity for higher itemized deductions could result in more donors itemizing deductions and maximizing available tax benefits for their charitable contributions. And, you know, on this next slide, I just wanted to highlight really kind of two key takeaways. Right, there's, again, re-emphasizing there's a new limit on charitable deductions. So if you're in that 37th federal income tax bracket, you know, and you itemize deductions when you're filing income taxes, you're still, you know, the donation will still count in full, but your tax break will be a bit smaller. So it's really a great idea to give now. Front load large future gifts to year end 2025, lock in that full 37% deduction value before that cap takes effect. So that's one key takeaway there. And then on the following slide, as I mentioned, there's a higher deduction floor for itemizers. So, you know, again, smaller donations may no longer reduce your tax bill unless they clear that threshold of 0.5% of your AGI. So there's that bunching gift strategy, combining several years worth of donations into one tax year to really clear that deduction floor. And by doing this as well as look at all of your assets, right? Not just cash, donating appreciated stock, life insurance policies, and other non-cash assets may help exceed the floor while unlocking additional tax advantages. And again, we're going to go into that a bit deeper later in the presentation here. On the next slide, I really want to highlight, you know, there are unusual income year opportunities. There's potential taxable events that where a charitable deduction is really a valuable conversation having to look into if you're experiencing any of these, whether it's rebalancing, a rebalanced portfolio, sale of a concentrated position, large income year, or windfall, again, if it's outside of your norm. And more money means a larger tax bill, right? So sale of a closely held business, Roth IRA, withdrawal from retirement accounts. All these scenarios can really would benefit from a charitable deduction. Okay. So hopefully I've painted an adequate picture of the current tax environment. So let's talk specifics about how you can maximize your charitable giving impact for this year. Okay. So we're now on slide 20. First and foremost, donating appreciated non-cash assets instead of cash. You know, that's strategy number one. One of the most powerful tax smart strategies is donating these appreciated non-cash assets that are held more than 1 year. Okay. You know, slide 21 here is one of my favorite slides. There's really a full range of options that you might explore to give to charity. This slide really illustrates some of the most common non-cash assets donated by our clients here. Some types of donations are more common than others, and you can see by the size of the square, right? While donors surely can make cash contributions to a donor advised fund, the majority of the gifts that we actually receive are highly appreciated assets. Actually, I would say, gosh, approximately 2/3, yeah, about 2/3 of that are publicly traded securities, including mutual funds and ETFs. Contributions of restricted stock, privately held businesses, and gifts from foundations are also common, but each with various considerations and deductibility levels. You know, we also accept other non-traded or illiquid assets. What's great about our team specifically at DAF Giving 360, we have folks in our charitable strategy group that really provide expertise around facilitating these gift transfers. So, you know, we were able to take on these complex assets. Slide 22.
Hey, Dave, do you mind if I jump in for a second?
Pause. Absolutely, Joe. Let me pause here.
So a planning idea that you may want to pursue is that many donors have both cash and highly appreciated stocks. Now, if the stock isn't a highly concentrated position, meaning it's not 50 to 60% of your overall portfolio, but if it's a company you wish to continue to hold, you could donate the highly appreciated stock to avoid the embedded capital gains and then turn around and buy it back with fresh cash, which will basically reset your cost basis in the holding. So what we're saying is if, for example, if you had a $50,000 position that you paid $10,000 for, and you really like that holding and you have $50,000 of cash, well, donate the $50,000 of stock. You just avoided the $40,000 embedded gain. And now you turn around and you have the same position at the end of the day for the same $50,000, but now your cost basis has been reset to $50,000. So now you get that higher bump. So if you decide to sell it in the future, that you've just minimized your gains by just swapping one highly appreciated asset and repurchasing with cash. Now, I also wanted to mention that for highly appreciated stock, to get the deduction based off the total value or market value, stock must be owned for at least a year and a day. If you donate appreciated stock that's less than a year old, your deduction is limited to the cost basis. So coming back to my earlier example, if you had a $50,000 holding and you only paid $10,000, and this year had a good year for stocks, and you might have realized this $40,000 unrealized gain in 8 months, if you donate that, you will be limited to the $10,000 purchase price. So that's just something to keep in mind when you're picking and choosing your stocks to donate. Make sure that the purchase date was at least a year and a day ago. Thanks, David.
Oh, absolutely, Joe. Great feedback there. Absolutely. Now moving on in terms of just explaining a little bit more on why non-cash assets are valuable here. You're going to receive a triple tax benefit, if you will. I like to explain it this way. You're going to eliminate capital gains tax, right? Also generally claiming a fair market value charitable deduction of up to 30% of your adjusted gross income on the contributions, again, as Joe mentioned, over a year. The excess, and this is important as well, the excess can be carried forward 5 years. That's an important note. So again, you're eliminating capital gains tax, you're claiming the fair market charitable deduction, but then also you're eliminating any assets contributed to a donor advised fund may be excluded from estate tax, right? So again, emphasizing the triple tax benefit on these non-cash assets. Let's show a quick illustration, right? Let's take a look at Carla here. Donors who use this strategy can really generally eliminate capital gains tax they would otherwise incur if they sold the asset first and then donated the proceeds, potentially increasing the amount available for charity. So option one, Carla sells the stock and then donates the after-tax net proceeds, as opposed to option two, where Carla contributes directly to the donor advised fund. And as you can see on option two, she can increase the amount available for charity and generate additional tax savings. Okay. Now, we touched on this briefly, but let's go into more detail. Multiple years of charitable contributions in tax year 2025. So to better understand the benefits of a bunching strategy, let's see the strategy in action. Let's take a look at Ava and Steve. This couple has no children and typically has $23,000 of itemized deductions per year, including a $10,000 annual charitable donation. The $23,000 in itemized deductions is right under the standard deduction amount of $29,200 for 2024 and $31,500 for 2025. With this in mind, looking at option two, they might consider bunching 2 years of charitable contributions, 2024 and 2025, into 2024. That gives them a $33,000 dollar total itemized deduction for 2024, and they then take the standard deduction over over the 2 years. The bunching strategy in option 2 produced an additional $3,800 in tax deductions. So that's a good illustration there on how bunching actually works. And now, the third point here, third strategy, is start contributing to charity with a non-taxable qualified charitable distribution at age 70 and a half, so QCD. So for folks on this call who own pre-tax retirement accounts, such as traditional IRAs or inherited IRAs, this strategy is going to sound like something to consider. It's called the qualified charitable distribution, also known as QCD. Some people actually refer to it as a charitable IRA rollover, and that's what it is. It's a direct transfer of funds from an IRA directly to a qualified operating charity. So, what's in it for the donor? Well, the key headline in that with the QCD, the distribution is completely excluded from taxable income. So this is unlike a regular withdrawal from an IRA, which is included in income. The QCD is powerful and it's versatile, really because it carries that income tax benefit. Whether you're itemizing or not, you can take a standard deduction and still do a QCD. You can take an itemized deduction for other things, and you can still do a QCD. So it's got flexibility. The folks that qualify, if you're in that retiree category who are, 70 and a half or older, and wonder whether it makes the most sense to make a QCD or instead donate appreciated assets, the answer is that it depends, right? It really depends on their individual situation and portfolio holding, because really each offers various tax advantages, but QCD is generally very tax favorable.
Hey, David.
Yep.
David, I just want to chime in here for a second. Just boots on the ground here. I will tell you that the amount of the percentage of these qualified charitable deductions here going straight from the IRA to charities has increased dramatically over the last few years in our practice. I tell you about 25% of clients take their required minimum distributions or RMDs about throughout the year. But then the remainder of them, if whoever has not taken them by Halloween, between Halloween and Thanksgiving, is when we start pushing them all out. And we processed a lot, more than we ever have this year, directly to the charity, which is great because I'll just reinforce, it satisfies the RMD. It is not taxable income to the client. And it actually now obviously it also goes as the charitable, the charity gets the money as well. So it checks a lot of boxes, and I have seen it in our practice be a highly utilized strategy. So just wanted to point that out.
Oh, absolutely. And working in the advisor space, that absolutely is a very viable option from a tax perspective that checks a lot of boxes from again, tax note, but also philanthropic perspective as well to maximize. And Dave, you covered some of my next slide here, but not to reiterate, but here are some rules of the road for the QCD. Really donating assets directly from the IRA without having to realize taxable income and help meet your minimum distribution, so your RMD, as they mentioned. So, a donor who is 70 and a half or older, you're eligible to direct up to $108,000 per year, tax-free, from their traditional IRA to operating charities. This excludes donor advised funds. So. This would have to go directly to a traditional 501c3 organization through QCD. Now, by reducing the IRA balance, a QCD may also reduce a donor's taxable income in future years, reduce their taxable estate, and limit their IRA beneficiary tax liability. So, and also one other note that we missed here. Tax payers who file jointly, each qualify for an annual QCD of up to $108,000 from their own IRA. Okay. So while withdrawals from traditional IRAs are taxable income, QCDs are not. QCDs can also be used whether you take the standard deduction or itemized deduction, but note, you cannot claim a tax deduction for a QCD there. That was a mouthful. I'm going to pause. Joe, is there anything you want to add?
Yeah, I wanted to add a couple other talking points here because inadvertently, if you took the distribution from your IRA and then you wanted to donate it to charity, you're thinking, well, I'm going to get the charitable deduction. No harm, no
Right.
foul. However, a higher adjusted gross income can have unintended negative tax consequences on other things that'll use either if you heard adjusted gross income or modified adjusted gross income. So for example, things like the amount of your Social Security subject to income tax. It could be as low as 0%. It could be as high as 85%. Anyone over 65 taking Medicare, your Part B and Part D premiums, also known as IRMA, though the more you make, or the higher your modified adjusted gross income, the government will increase the amount of your contribution for your Medicare Parts B and D. As well as if you have a lot of investments kicking off, say, capital gains taxes, qualified dividends, net investment income taxes. Once you hit a certain threshold, you can kick in an additional tax for that as well. There's also, we were talking earlier about the SALT deductions. The SALT deductions get phased out for example, in a married couple. If your adjusted gross income is under $500,000, you can take advantage of the full $40,000 if you have the taxes that high, but they're completely phased out once you hit $600,000. So taking a $100,000 IRA distribution and then donating it to charity may have negative consequences for the rest of your, basically income tax potential bullet points here. So if you donate directly from your IRA to charity using a QCD, you're going to avoid all the higher AGI options and potentially higher income taxes. So, thanks, David.
Oh, absolutely. Great point there, Joe. And let's take a look at cash versus qualified charitable distribution here in a brief illustration. Option one, Bob's AGI is projected to be $80,000, but if he takes his RMD income of $42,683, it will increase his AGI to $122,683. So if Bob then donates his RMD income to charity, he would take an itemized deduction of $42,683, assuming he has no other deductions to itemize. This results in $80,000 in federal taxable income. Option two, however, if Bob instructs his IRA administrator to direct his RMD as a QCD to an eligible charity, the RMD would be excluded from Bob's taxable income. Bob then takes the standard deduction of $15,750 for 2025, plus an additional standard deduction of $2,000 because Bob is over 65 and has a single filing status. Therefore, his charitable deduction totals $17,750. So as a result, his federal taxable income is reduced to $62,250. So sometimes the illustration really hammers home the point there. Now, next steps. Everyone that has participated today, it's all about, again, education, as I mentioned earlier, understanding your giving options and what's the best option for you moving forward, utilizing the best assets, right? Timing, consider timing, what again is most appropriate. Again, not just from a tax perspective, but philanthropic perspective, and really creating these giving strategies that can maximize your charitable giving long term. It's best obviously to engage your team of advisors. If you don't have a current team, I know Dave and Joe, the folks at OnePoint, are excellent and would welcome any conversation around charitable planning. Myself and my role here at DAF Giving 360, I'm happy to be a direct resource should you be interested in forming a donor advised fund. But again, always happy to be a resource for you. And to that point, I do want to highlight some key resources that we have here that I'm happy to share with the group. I'm not sure if I'll send over to Phil, if you can populate over to the group, but no matter where you are in your philanthropic journey, it's really always the right place at the right time to start fresh and create a new giving strategy, or really, examine and enhance an existing plan. So, we actually have what is called a DAF Giving 360 Giving Guide, which is really designed to help folks and their families as you make thoughtful and strategic plan that allows you to maximize your charitable impact. So, we go into things such as defining your charitable mission, how to involve your family, generate a real comprehensive giving plan, like anything else that evolves and grows, just like life, right, in general. So happy to share the giving guide. And one other key resource here, as you're looking to engage, if you have to engage the rest of your family, we actually have a series of guides that can help involve family members to design a plan for meaningful, effective philanthropy. So again, different resources to arm you to have conversations with not just your family, but your advisors as well and your team. This is want to encourage giving and the ease. I think that's really the key takeaway: the ease of giving. Maximizing your charitable dollars to again make it work not just for you but for the world, right? So I want to pause and thank you guys for your time here today. Any questions from the group that we can address?
David, thank you for a thoughtful presentation. We have a question from Mark. If you just want to unmute yourself, go ahead.
I'd just like to know how we can get in touch with Dave.
We have two Daves, Dave Johnston.
Dave from Schwab.
Dave from Schwab. Dave, would you be comfortable with us sharing your information, your contact information following this call?
Absolutely, and I'm happy to share some additional information and resources to you, Phil, if you like to populate it to the group. Again, really happy to be a resource for anyone on this call as you think about different giving strategies and what works for you. Again, happy to be a resource for you.
Great. Dave, let me ask you a question. How difficult, if I'm someone, right, obviously it's December 1st today, end of the year fast approaching, how hard is it to, generally speaking, open a donor advised fund?
So simple. Again, the key takeaway here in my presentation is the ease of giving, right? And we make it easy here at Schwab at DAF Giving 360. You can actually go online and finish the process in seconds, and we can have your account open, within a day. It's very, very simple. If you're talking about appreciated stock contribution or even cash, everything is very, very simple and transparent. I do want to say that obviously, we are in giving season. It's December 1st, right? And we can take contributions all up to the end of the year, but we try to avoid fire drills where they are not necessary. So sooner rather than later, if you are deciding to do this approach to give now, to give in 2025.
I'll also chime in on that in terms from a timing perspective, Phil, is that last year it was a little bit of a fire drill. It was after the 20th, I know, of the year. Within 5 business days, we had the account opened within a day, but within 5 business days, we had nearly $3 million of highly appreciated stock successfully transferred into the DAF, and we were way ahead of schedule on there. But it felt a little too close for comfort for us. We'd rather have it done earlier in December than later, but it can be done. It is rather seamless and easy.
Right. And I think you can appreciate we are built for speed, but we're also human as well. So any grades we'd appreciate, but noting that you have that timeline and emphasizing that you're going to get the full deduction in the year that you contribute. And again, you can contribute over time, and every time you make that contribution to your DAF, that you'll get the deduction in the year you contribute.
Yeah. Dave, I'll just you know, I want to add a couple of comments. When I introduced this idea to Dave a few weeks ago, you know, one of his questions to me was like, aren't you competing with yourself when you encourage people to give to donor advised funds? And I think of it like, you know, a donor advised fund is a vehicle by which people do charitable giving to charities. So there are tax advantages for individuals to open donor advised funds, but the ultimate goal remains the same, to provide a gift to charity. And we have seen an explosion of contributions through donor advised funds. And so it's really, for us, it seems the vehicle of the future that people are using to make contributions to charitable entities, including us. In addition to that, as the world is changing, so is the technology around it. Most charities, if not all, can accept contributions on their website, usually via credit card. Today, the Hunterdon Health Foundation can actually accept a gift from a donor advised fund through our website. So you can fill out your information. We're connected to the most common donor advised funds across the United States, like Schwab, and you can make a distribution from your DAF immediately through our website. So they're definitely a great vehicle for us to engage in. Anybody else have any questions? Joe, Dave, and David, do you have anything else you'd like to add?
No, that's it for me.
No, I'm pretty good as well. I'm here as well. Happy to be a resource for everybody, even if it's just making some connections or having some informal up to formal conversations. I'm just here to help facilitate.
Yeah,
I mean, what I always say is, if you think of a question after we hang up, just reach out to Phil with your question. He can reach out to David and myself, and we'll get back to you, as soon as possible to answer your questions, because again, you might not be thinking about it and 5 minutes later it just pops into your head. So please don't feel like you only had this time. Send the email, send the question, and we'll get right back to you.
Absolutely. Good. Well, with that said, David, Joe, thank you again for this presentation. I greatly appreciated. We will be sure to share that with everyone once the recording is made available. And if you do have, as Joe suggested, any questions, please do not hesitate to reach out to myself or Jenna. And you can do so at foundation@hhsnj.org. Again, we'll send our information out as well. Thank you all, and have a wonderful holiday if I don't speak with you before the coming holidays.
Take care.
Thank you all.
Bye-bye.
Have a great night.